first episode of... We haven't thought of the name yet. Today we're really lucky to have Mark Pimentel here with us. Welcome, Mark.
Hey, how are you?
Mark Pimentel is one of the most profitable and experienced trader in the world. So Mark, could you tell us a little bit more about yourself, of the main reasons that brings you to the success in this field?
Sure, so I've actually spent about 11 years in quant trading. I started off in Chicago, moved to New York, and then went back to Chicago. Worked at some really large hedge funds, some large trading companies as well. I think a lot of what makes quant trading such a great field is that it's really one where you can be very creative. There's a lot of game theory, there's a lot of psychology, and in addition to machine learning and statistics. And so I think that the combination of all these different things make it just such a fun field to be in. So it's really one where I have a lot of passion and one where I really enjoy the work that I do. I think that's part of why I've been doing it for so long. I think the math and the stats is definitely really important, but a lot of times when we bring people in to see how some of the things that we do, I feel like a lot of them are very surprised at the kind of models that we employ, because a lot of them are based on very simple things. Sometimes the mathematics are actually quite simple, but a lot of the different models are based on economic theory and psychology and market microstructure. So a lot of it is really trying to understand how all these different things fit together, and trying to create models that will try to predict how things move, and models that will try to explain complicated dynamics in ways that are a lot simpler, such that we can kind of replicate them in a more stable way.
So a thing I think most quant traders are curious about is what makes a good quant traders from the less good ones?
I think it's really a focus on adaptability. A lot of times you will create a model and you'll see that it works on certain periods of time, but maybe not others. And so a lot of times people will just kind of give up. I think the important thing is to realize that a lot of times you're really trying to search for something in a very noisy and a chaotic field, and so the persistence of being able to try to shine a little light in that darkness, I think is the really important part of trading.
So you had a kind of like a huge success at the Citadel, which is kind of like a dream job for most of the traders, but you choose to give up this position in big companies and start doing startups. So why is that?
Well, I've spent a large part of my career in different companies in the trading space, and I think that over time, I decided I just wanted to try something a little bit different. And when cryptocurrency came, there's just so much growth behind it and so much explosiveness that I think the combination of being able to do what I love in trading, in quant trading, and do it in a field that's so exciting, it just made me really want to try something in that space. And I think a lot of it also is that there are places like Taiwan where there's so much opportunity, and it just presents such a great opportunity for a startup like this.
So from a quant trader point of view, does working in a big company and working in startups affects the strategy in any kind of way?
Well, there are different places to work. I think from a trading point of view, large companies they tend to be a little more compartmentalized. So you'll know a couple different things really well, but you might not know the whole strategy or how everything kind of fits together. But working in a smaller company, there's fewer hands, so everyone has a much better understanding of how the whole system works. You hear a lot about black box trading, and part of our job as a quantitative trader is to create that black box, understand all the different pieces in it. And so working at a big company, you kind of have a smaller piece of that, whereas working at a smaller one, you understand more of it. It's different because if you have a bigger box, then there's also more to understand.
So Mark has a great success during the financial crisis in 2008. He had a huge success in his career during that period. As a quant trader, what do you think about the financial crisis?
Well, I think the financial crisis was a really unique time period. and it's characterized by a lot of volatility. And one thing that traders, especially quantitative traders, kind of look at as something that is very correlated to their success is this volatility. So volatility is kind of describes how markets move, so how violent different changes are, and kind of the magnitude of different shifts in prices over time. And one thing that is kind of an aspect of markets is that when they are falling, they tend to fall more violently than when they rise. And so that's something that I guess one part of different strategies that I tend to work with is that they're actually a good hedge against price moves, because when markets are kind of disrupted and they're a little more chaotic, that's when many different quant strategies actually do better.
From an economic point of view, people after the financial crisis, they're saying that in the past, all the models doesn't really fit the financial crisis because of the models. So hence the financial crisis happens. That's when the behavioral economics comes out and all that kind of stuff. Does that affect your strategies since then, or know that beforehand?
Sure, I think a lot of models, price prediction models and trading models, they try to generalize. They try to find different concepts that work well over bull markets, bear markets, slow markets, fast markets. And so it's just another piece to try to adapt to, in my opinion. A lot of times when you have markets that are more volatile, it simply represents more events happening in a shorter period of time. Whereas if they're not as violent, then it's just more period of time, a longer period of time between different events. There are other differences as well, but that's just another way to think about it.
Satoshi published the Bitcoin white paper right after the financial crisis, and there are some people arguing that Bitcoin will be the haven of the next financial crisis or crises. Do you think that is the case?
I mean, it's really hard to say. I think a lot of people say that crypto is a place where people have that flight to safety, but I think in recent months the correlation has actually been quite high between some of the traditional assets and cryptocurrencies. So I think that the field is still pretty new, and there's the changes even over the last few years have just been so dramatic year to year that's really difficult to predict.
Do you think when the next financial crisis comes, the Bitcoin will fall or will survive?
Well, I mean, it seems as if the correlation is actually a lot higher than people expect. Even though people say that it's kind of like a digital gold, maybe it'll act like gold. And the reputation for gold is that it's kind of counter-correlated. I mean, my opinion on cryptocurrencies has always been that, I mean, if you see all the different professionals that are quitting their jobs in the traditional sector and going to work in cryptocurrencies, if you see that as a trend that will continue, then I think that you have to be bullish on cryptocurrencies, because I mean that type of shift in the workforce represents productivity. There's an economic productivity of having people go and work and create products in the space and create technology and develop the technology and try to develop applications and try to disrupt businesses. And so I see that as something that's still continuing amongst my peers and other people that I meet. And so personally, I'm very bullish.
You've been through traditional hedge funds and now to crypto. And people understand there are difference between these two markets, but obviously not as good as you. Can you tell us, from your perspective, what's the main difference between crypto market and the traditional market?
Well, the crypto markets are still very new, and I think that part of that is that it's going through a lot of growing pains of the equity markets. It took many hundreds of years or so to go through things in terms of the regulatory environment in different places and how that affects traders and what they can do and what they can't. Crypto is a global market, and it's one that has become global very quickly. And so you're trying to integrate traders from all around the world into a couple of different assets. And so that has its own, that has a different set of dynamics. I think that a lot of crypto traders, especially early on, we're not as sophisticated as a lot of the more professional traders of traditional markets, and so there's kind of an adjustment period there also. But my view is that over time, the crypto markets will become more and more efficient and more similar to the traditional markets. So a lot of the lessons that we've learned in traditional markets and a lot of the ways that we see them trade, I think, are going to become more and more similar to the crypto markets.
Do you think they'll become like two different markets with two different characteristics?
I think it'll just end up being another asset class, one that's regulated differently but more similarly to existing asset classes. I think if you see the trend of how crypto currencies are moving, there's trends there are trends, for instance, where we're going into looking at security tokens, which are going to be a lot more regulated than utility tokens. They're going to be a lot more. They're going to be scrutinized in a lot of the same types of ways, and so I think those will move more similarly to traditional equities, for example.
So the community are worried about crypto might become another .com bubble. So a few days ago, Bernstein published a private report, and the main idea is about, quote, 24/7 trading market acts as a natural correction system for the bad actors, unlike the .com bubble, where the feedback for weak business models came with a lag. Is this consistent to your experience in quant trading, or it's not?
I think the 24/7 aspect of markets in crypto is one that makes it different, but I think ultimately doesn't necessarily affect it as significantly as people would presume. I think part of, if you look at how markets work, a lot of the changes in asset prices are due to kind of outside, like external shocks or news. So when news comes out, the market will try to internalize that and through its movements. And part of what happens when the markets are closed is that it doesn't have a chance to internalize that. But if the market is sufficiently efficient, then once a news release does come out during or even after market hours, then it should be able to absorb it relatively quickly. So I think that there might be some informational disadvantages in crypto markets where this concept of news is not one that is as readily absorbed or as readily disseminated as in traditional markets. But ultimately, I think that people are still able to internalize that information pretty quickly. So I don't quite agree that it's something that would allow markets to bubble up, as at least the fact that it trades 24/7.
So you don't think it will be like another .com bubble?
Well, I'm not saying it's not a bubble. I'm just saying that the aspect of it trading 24 hours doesn't necessarily mean that if it's a bubble or not.
What you're saying is that crypto has a much higher risk than the traditional market. How do you contain the risk management in quantitative trading? This aspect.
Oh yeah, I definitely think that cryptocurrencies have a lot more risk. If you look at the realized volatility of cryptocurrencies, it's a lot higher. That's no question. I think the risk management is something that's just so important when you're trading crypto. It's really one where you need to kind of balance your risk tolerance and try to balance how your algorithms will respond to different events, different shocks, different price moves, in a way that's conducive with kind of risk that you want to take. So I guess you can make more money if there's more risk, but you can also lose more money. So it's something that you got to just be cognizant about.
Last question. Now in Taiwan, there are a lot of students that are ambitious about being quant traders, and they want to devote themselves into this field. Can you give them some advice from your aspect?
Sure. I think quant trading is such a great field to get involved in with. I think that if you think about what trading provides, this aspect of liquidity and efficiency, it's something that is ultimately sorely needed in the crypto markets. So I think in terms of the service to the ecosystem, it's something that's definitely in everyone's favor. I think from an individual kind of student's point of view, a career of looking at quantitative trading models and execution is just so fascinating because there's so many different elements to it. We've covered, understanding of economic theory, of game theory and psychology, understanding how markets evolve and how they behave, and then also the statistics, the data science, the machine learning. There's just so many different angles that you can explore. And if you ever decide that you want to do something different, there's just the skill set will just translate into so many different things. So I think in terms of the future of Taiwan and its students and its young people, kind of embracing more quantitative disciplines, especially trading, is one that I think would be great for the country. So part of the reason that we're here is that we believe there's so much talent in Taiwan, and a lot of that talent can really be applied to cryptocurrency, to quant trading, and we believe that it's just such a great place for companies like ours because of that.
Mm-hmm. Do you think crypto is like a good first step for a freshman to come out as a quant trader?
I think anyone trading crypto needs to be careful of the risk and the volatility, but I think that if it's something that you're fascinated by, and if it's something that if you want to try trading, then it's something that you can definitely try.
Okay, that's about it today.